Qualcomm just reported their Q4 numbers, and the market showed us exactly how they felt about it with an immediate decline of about 7% during the aftermarket session. The semiconductor beat on estimates but provided weak guidance for the next quarter, which is likely the reason for the decline. So, with all of that in mind, we have to ask ourselves if this decline is justified or if this is just another instance of illogical market behavior that gives us value investors another buying opportunity. Make sure you stick around because we'll answer all those questions and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. Today, we are going to start with an analysis of the fundamentals. We'll go through the top line, bottom line, balance sheet, cash flows, etc. And we'll conclude with an evaluation of this business using our intrinsic value calculator. If that type of content interests you, make sure you subscribe, like the video because we post on here regularly. And without further ado, let's jump into the video. All right, so Qualcomm's Q4 earnings results. What exactly do they do? If you didn't know, they actually have quite a large product array ranging from low complexity products all the way up to high complexity ones. Mainly they're a chip maker with decent market share and lots of different partnerships. We'll get into that in just a second. First, let's talk about what the CEO mentioned. And essentially what they've said here is that despite the macroeconomic challenges, they're continuing to execute their strategy on transforming Qualcomm from a wireless communications company to a connected processor company for the intelligent edge. However, their financial outlook is temporarily impacted by elevated channel inventory, but their long-term strategy remains unchanged. Okay, let's dive into that a little deeper. Qualcomm is mainly comprised of two different business segments. They have QCT and QTL. We'll start with QCT here. This is essentially their semiconductor business. We can see right here on this slide, revenues grew this year 39% up to $37.7 billion. And then they have their QTL business. This is their licensing. Revenues for this segment are actually flat year over year, so not much change there. But let's take a look at what's actually growing in the QCT business. And as you can see, handsets grew about 49%. Their RF front segment actually only grew about 4%, but automotive really took off with a 41% increase, and Internet of Things also took off with a 37% increase. So they're seeing some really strong growth there in the QCT business, and they're really looking to further increase their Internet of Things revenue stream. As you can see, they're on track to achieve about $9 billion in revenues by 2024. Right now, we're sitting at about $7 billion in revenue. So they have 2 more calendar years to achieve that $2 billion increase. And as you can see, since fiscal year 2021, they were able to increase it about $2 billion as is. So they might be able to achieve that by next year, but they have alluded to a bit of a slowdown for the next year. We'll talk about that in just a second. And as you can see here, this is probably another reason why we had a decline so far after hours. They're saying that they're going to be facing some challenges in the semiconductor industry as a whole with demand weakness and elevated channel inventory, which we spoke about just a little bit earlier. But in terms of the demand weakness, they started to see a deceleration in demand in mass tier handsets and consumer Internet of Things. And they're now projecting that the 3G, 4G, and 5G handset volumes are going to decline by a low double digits over the next year or so, which is really going to impact fundamentals, especially if it's in that 10 to 15% range. Then they also have elevated channel inventory. We'll speak on that once we get to the balance sheet. We can really see what that looks like there, but they're seeing rapid deterioration in demand and easing of supply constraints across the semiconductor industry. So they only have about roughly 8 to 10 weeks of elevated inventory remaining, but that over the next couple quarters, this should be worked through on its own. And they're confident in their ability to navigate this environment successfully. So this is really just a message to their investors to stick around with them because they do have things like this. As you can see, they've just partnered with Samsung here, and this partnership is meant to reaffirm their commitment to expanding technology leadership and delivering the world's best device experiences. So really, they're extending their patent license agreement until 2030. Additionally, they're also partnering up with Mercedes-Benz as they're looking to deliver best-in-class driving experiences. And finally, they're also partnering up with Meta as they look to take over the augmented reality platforms as they look to revolutionize the future of computing for billions of people in the coming years. This is actually huge for them, especially if Meta can really hit the ground running with the metaverse. Yeah, Qualcomm's definitely going to benefit from that. All right, so with all that being said, that leads us to our statement of operations here. $9.8 billion in equipment and services, $1.5 billion from licensing. That leaves us with $11.4 billion in revenues. It cost them about $5 billion to produce those revenues. And then after, once we deduct for our research and development, SG&A, etc., we're left with operating income here of $3.6 billion. This is up from $2.9 billion a year ago. So investors should be happy about that. And when we look at this from a 12 months ended perspective, we can see $44.2 billion in revenues, up from $33.5 billion in the previous year. Solid growth there. Not too much growth on their expenses, and that's why they left with $15.8 billion in operating income, up from $9.7 billion. So the fundamentals are intact. It really just depends on what's going to happen when we start to see some impacts from the lessened demand. Now let's talk about the balance sheet a little bit. $6.3 billion in cash with $15.4 billion in debt. Yeah, nothing really to worry investors, especially with a bunch of inventory and receivables here and a growing book value as well. Now, finally, that leads us to our free cash flow statement. We can see the cash provided by operating this business was about $9 billion for this year. $2 billion in capex leaves us with with free cash flow of $6.8 billion. What exactly do they do with that? Well, they're splitting that between repurchasing shares and paying out a dividend, which is the typical way most businesses are rewarding their shareholders. But with all that being said, it's time for us to evaluate this business. First, let's assume that we are going to have a slowdown in this business, especially in their operating income, and that once the inventory works its way out and the demand starts to decrease a little bit, they can produce on an average basis about $7.5 to $10 billion in operating income. We'll plug that into our calculator. So on an average scenario, if we say they can produce about $9 billion in operating income, we require a 10% return. They do pay a dividend, and that in an average scenario where the decreases in demand don't impact fundamentals too largely, we can still estimate that this business will grow at about, let's call it 9% per year for the first 5 years. That drops down to about 7%. On a 10 PE like they're currently trading at, this stock should be worth about $143 per share. Right now, we're currently trading at $112 per share, so one could argue that now is a great time to pick up shares. Now, in the best case scenario where there actually isn't much of a decrease in the demand, some of their strategic partnerships start to gain a foothold. This business can grow at, let's just call it 15% for the next 5 years. That stays constant at about 10% for the 5 to 10 years after that. On a 20 PE, yeah, this stock would be worth about $300 per share. So that is some significant stock appreciation. But in the very worst case scenario, where we really see a decline in fundamentals over the next few years, they're only able to grow at, let's just call it 4% for the first 5 years. That drops down to 2% on a 9 PE. Yeah, this stock would only be worth about $100 per share, which, to be fair, is only $10 off where we are right now. And actually, after hours, we're trading at about $104 per share. So I mean, we're technically kind of trading at a margin of safety investment, assuming these growth rates here play out, especially over the next 10 years. And I'll tell you what, if their partnerships actually work out the way they intend them to, and they don't see as big of a decline as they're expecting in the demand, or at least if we see a resurgence in demand towards the end of the year, Qualcomm might actually be fairly valued right now. However, if you are of the belief that they are actually going to have a slowdown for longer, fundamentals are going to be severely impacted over the next few years, there's way too much competition in this space, then yes, we're going to see lower for longer. But with all that being said, let me know your thoughts on the comment section below. I personally think this stock is going to see a nice rebound, especially once the economy rebounds. And for that reasoning, I'm going to keep this stock on watch over the next few quarters. That's the analysis for Qualcomm's Q4 earnings. If you enjoyed it to this point, please like, subscribe, and I'll catch you on the next one.